Good afternoon. My name is Randy Milch, and I want to welcome you and thank you for attending the second panel of our cyber conference here. We are going to be discussing for an hour the critical topic of cyber insurance. And I'm joined today by three experts in the field. There's Jeff. He's just joined us. Three experts in the field. Their bios are set out in some detail on the conference website, so I will not be doing a lengthy recitation of their bona fides, but take my word for it. We've got some pros here. I will tell you in brief that we are joined by Jeff Bohn, who is the Chief Research and Innovation Officer and Head of Research and Engagement at the Swiss Re Institute. We have Matt McCabe, who is a Senior Vice President and Senior Advisory Specialist for the Network Security and Data Privacy Group at Marsh USA, which is a global insurance brokerage and advisory firm. And we have, just to make things more confusing, another Matt Prevost, who is Chubb's National Product Line Manager for Cyber and Technology and the E&O product line. So what we have for you today is two insurers. Jeff, I'm going to put you in the insurer category here, even though you're.
I'm still an insurer, yes.
The insurance category. Two insurers and a broker, the brokerage firm and a consultancy, to discuss with everyone the critical topic of cyber insurance. And I want to open it up by just giving you a brief word on and framing this a bit for the audience today. Whoops. Audience, it's. I think everyone accepts that insurance plays a critical role in the modern economy. Insurance spreads the risks of modern life through its contracts, and hopefully it works to lessen those risks through underwriting practices. Prior to our global lockdown, I would have been tempted to say that cybersecurity risk is in the first ranks of risks associated with modern life. I think it still probably ranks pretty far up there. And as the last panel discussed in some detail, and we will also discuss a bit, the sudden and very vastly increased online workforce certainly brings to fore the interplay of the digital life, of the dangers of that digital life from cyber insecurity of some sort or another, and the pandemic world we're living in. So we are going to cover this afternoon a range of topics. I'm going to start off with the basic contours of this type of insurance, because I think it's important that we level set for everybody what we're going to be talking about, the basic contours. And then we will continue on with talking about the financial health of it, the function of it, the underwriting aspects, and the like. So that is the short version of our agenda for this afternoon. So let's begin with just some basics on the cyber insurance market. Who wants to start? Let me start with Matt McCabe. How would we think about how large it is, growth of the market? Give us a little bit of a history and the growth characteristics of this market.
Yeah, absolutely. And I'll ask my colleague Matt Prevost to kind of tag team me with this from the carrier's perspective. I think current estimations that the market is about 2.5 billion in global premium written, and I've seen estimates about growth how that by the end of the decade that could go up to 20 billion. I think that those estimates are all derailed at this point. We'll just have to wait and see what happens. But certainly over the past years, we've appreciated double-digit growth as far as number of companies buying and overall limits being purchased. Everything's been going up at a not a tepid pace at all, but a very robust pace. And you look at some industries over the past couple of years, power utilities, manufacturers, companies that have not had the data privacy concerns to be early adopters, but who have really been coming on board. So it's certainly a sharply growing market.
Yeah, I would just add just the number of insurers and a little bit of history around cyber insurance. Started in right around 1999. So there's almost 20 years of substance, or at least of data and history associated with cyber insurance. As things evolve, which we'll get into, so has cyber insurance. 70 there's approximately 70 plus markets that participate in cyber insurance, and that ranges everywhere from significant primary players who are proximate to the risk, all the way up to the reinsurance community, including the insurance-linked security market. Many insurers have differing levels of underwriting discipline, differing views of investment in modeling, and then obviously different levels of access to various data, and then also technology tools that we've heard about. So we'll get into a little bit more detail. But again, as Matt mentioned, the growth rate of gross written premium, the projections that we're seeing range anywhere from 20% to 50% growth over the last, 5 years, inclusive of the forward look on the next 5. And it is seen as a growth product for the insurance industry overall, relative to other more traditional products. And again, we can get into a little bit more detail. Matt mentioned some buying behavior too, right? So individual risk can buy in excess of $750 million in limit, which is considerable leverage in the grand scheme of things when you think about the gross written premium. The other kind of important aspect to understand is the differing loss ratios across the different market and the different underwriting strategies. Reported loss ratios range anywhere from 0%, which ultimately mean that a risk bearer has incurred no losses, all the way up through 100%, which ultimately means an insurer would lose $4 for every dollar written in the cyber insurance space, which is important to understand as we start to talk a little bit more of trends and updates and some of the different things that we're seeing.
Let me ask just two clarifying questions on that. You said about 70 folks are in the market, 70 companies in the market. What's the denominator we should understand that goes along with that 70?
In terms of premium, or in terms of just insurance companies overall?
Just insurance companies overall.
It's a small percentage of insurance companies overall. And I'm speaking specific to the affirmative cyber insurance space, which is important to understand. Whereas the number of insurance companies in the world, and again, I'm not 100% positive with this answer, but far in excess of 1,000, right?
Okay.
So it's still I would refer to it as still a specialty product, but it's becoming a little bit more core in the grand scheme of things as buying behavior changes.
And I can give you a little bit on the global. There's probably 500 to 600 insurers that seem to be working in this market, and I would like to highlight that the numbers and the estimates cover quite a wide range. I mean, I was pulling some of the data before this, and this is not necessarily Swiss Re's position, but some of the estimates are as much as 30 billion by 2026, all the way out to what was mentioned before, 20 billion by the end of the decade. So people are a little bit all over the map about where this is headed, but the growth is up.
So let me switch it around. So if you think about it from the insureds or the potential insured's view of the world, where are we on the ubiquity of this type of insurance? Does everybody have it? Is it a scarce instance, or what are we looking at when we look at the insured side of the world?
Yeah, I think, well, from our perspective, we characterize that in terms of what we call the insurance protection gap. So that's the amount of possible insurance relative to what's actually written. And we still see quite a gap. So, I think this is still quite in the early stages. If you look at the overall gross written premium across the entire insurance market, it's still, low single digits in terms of percentage of overall risk segments, but the growth rate is high. And so I think that's the important point.
Yeah, and Jeff, I would agree. I think the buying behavior, right? So when we kind of look at small business versus large enterprise customers, penetration rates within the large enterprise space, at last estimate. And again, I think a challenge with some of the cyber insurance data is that a lot of it is really estimates because of the lack of consistency as data collection occurs. But in the large account, the enterprise customer on a global basis, we estimate that to be in excess of 50% purchase. So, in some respects, the majority are starting to buy some element of cyber insurance in that large enterprise customer. Whereas in the small business space, it still is single digit. And that's, there's various drivers for that. It's awareness, recognition of risk, it's broker education. So there's a lot of different variation there. McCabe, I don't know if you...
Yeah, I mean, I would say that every company has cyber risk and different policies respond to what that cyber risk is. And then you have to really break that down into cyber insurance, and the take up for cyber insurance will largely deal with data, the availability of systems, and potential liability. And I agree with Matt. I think that number has reached, certainly in the larger company space, over 50%. I do think that this is going to be as widely adopted as property, so there's still a lot of room for growth.
Yeah.
Just to be clear, I was talking about the relative to what could be covered, not in terms of the percentage of actual purchasers. But
okay.
I mean,
and just to add, I do think industry buying behavior that both we see and I think the marketplace sees is the relatability, right? So when a large event occurs, that industry tends to kind of recognize the impact, and so does the buying behavior, particularly in the enterprise space.
Okay, thank you for that. I think that it's important just to give those sorts of contours to the popularity of the product, the growth of the product. Let me ask you one further sort of state of the market question, and that is, and this goes to a little bit of what we're going to discuss later on about aggregate risk, but when we talk about the 70 players that are in the market, let's look down into them for a second. Is this a significant portion of their business? Is this a minor portion of their business? And which I think goes to this question about how robust the potential, the ability to pay out is, especially if you had a 100% loss ratio that some poor insurer has. So are we looking at significant portions of the risks that these insurers are taking on being in the cyber area, or a relatively low portion of their risks? And I'll let whoever wants to go first.
I'll start. Just from a risk bearer perspective, there is significant variation in that answer. From Chubb's perspective, a very small percentage of our gross written premium is attributable to cyber, whereas some of our larger competitors, a almost majority of gross written premium is attributable to cyber, which is a topic, and it goes to the diversification of risk, but also the significance of investing in enterprise risk management and looking at this I like one of the earlier comments on kind of pre-mortem thinking, right? Is modeling and thinking about, what can occur, what will occur, what could occur, and the impact, not just the cyber insurance, but also the impact, the overall health of the risk-bearing organization.
So when I looked at this topic a little while ago, it seemed like that the folks with almost a majority or a very significant portion of their risk associated with cyber was an outlier position, and that most of the well-known insurers had in the single-digit percentage in the cyber area. Is that a fair characterization of what you all understand to be the case?
Yes.
Yeah, I think that's fair.
Okay, and let me ask you one final question about where the market looks. Is this a profitable line of business? And is it your views that it's going to continue to be a profitable line of business? I know that's sort of in some ways the $1 million question, or the $1 billion question. But how do you think that the companies are able to model this risk, which is in some respects, as Matt said, 20 years old? But every time I talk to the insurers about their understanding and their analysis, they say, "Oh, but it's only 20 years old." So 20 years old can be good or bad in this prospect. How do we think it's profitable? Jeff, why don't you take that first from a...
Yeah, well, I think the data so far suggests it is profitable. I mean, the thing that concerns the industry is accumulation risk. And so that holds back, I think, to some extent the growth and why you have more prudent diversification on the part of the larger insurers. The bigger issue going forward is the ability to better segment the marketplace for different types of cyber risk. And I think that's what we're struggling with. And from an actuarial perspective, 20 years is not that long anyway and often that's the complaint I hear from the underwriting communities. There's just not enough data yet to really price many of the different segments in a very granular way. So I think that will continue to develop. And since it is still relatively new, the profitability over the long term is something that we will have to continue to watch.
Matt, do you have an addition you want to make to that?
Well, I would add, there's always the comment 20 years is not that long, but in cyber especially, 20 years data is just yesterday's data, and it's a very morphing risk, especially the way that we adopt systems, especially the way we connect systems, that perhaps the 20 years of data that we are relying on is a bit antiquated and becomes dated very quickly.
Yeah, I would add just coming into 2020, right? So some of the realities that the marketplace was working through, was adjusting to, and really attempting to be agile is obviously frequency associated with ransomware. And then, the element of how do we reduce that frequency, right? The underwriting discipline associated with that frequency. It's starting to come to fruition, and obviously that's heading into 2020. The component of that is you're also starting to see, underwriting strategies that differ, by carrier, which is really important. That's a good sign. It ultimately is, there are good underwriting decisions, there are good risks, and there are obviously bad underwriting decisions and bad risks. And, again, Matt McCabe's comment, and also Jeff's, I think there is a recognition that 20 years isn't a substantive enough amount of data, nor does it look forward into what the accumulation type risks are. Which again, I think that is the important aspect. And as the attritional loss ratios continue to come up, primarily due to ransomware, we can talk about some of the other privacy regulation and some of the different threat actor groups and the focus. That's really what the marketplace is working with, is really trying to get a grasp as to how do I bring down and eliminate those frequency events, but also recognizing what those severity or catastrophic events are.
Okay, we will, I've been looking at the questions. We will get to the whole TRIA government backstop toward the end of our discussion. So we can deal with that. Let me take you back, because I think this is important. One of the Matts, I apologize, I can't remember which one, talked about affirmative cyber insurance. And I think that it's important to give the audience a little bit of a flavor here of how cyber insurance grew out of or became a separate risk from sort of the property and casualty line of business. And one of the questions we just had, I think I would want to think about answering. It's sort of the moral hazard question. We had a question about are insurance companies fueling a rise in ransomware, but let me abstract that a little bit. The property and casualty business was not sort of built up to, fire insurance wasn't really designed just to deal with arsonists, right? But in cybersecurity, we're dealing with arsonists. We're dealing with criminals in a large part that are the profit motive is bringing to them. So do you see the sort of moral hazard aspect of insuring companies against criminal behavior? Do you think that there's any sense in which the presence of insurance is diminishing a company's desire to prevent the loss as opposed to simply spread the loss? I personally would be amazed if any of your answers were yes, but I would love to have your views on the topic.
I mean, beyond no, I think it's counterintuitive. And I'm aware of an article that kind of kicked off this discussion of, is cyber insurance encouraging ransomware because it's making payments? I mean, nothing could be less tethered to logic, in my opinion. So let's take a company that has a ransomware event and its systems are down and it can't perform operation and it has no insurance. That company has more incentive than anybody to try and pay that ransom, that extortionist, and get back online as soon as possible because everything's coming out of their pocket. You know, it's the company that has insurance, that has a backstop, and might actually want to think about, do we want to participate with this criminal demand? I mean, they at least have a little more flexibility. So counter to a moral hazard, I actually think it hedges the other way. Now, if you look at the overall balance of equity, what that company is going to decide to do, every company wants to get back online. Every company wants to return to operations just for things so that it can handle its customer base, it can preserve its reputation. There's a whole host of reasons why that extortion demand might be paid, but the fact that you have insurance is not one of them.
Yeah, and I think that premise, you know, it also ignores really the capabilities that these policies bring, right? So the legal perspective, the forensics perspective, really the experience every day with negotiating and ultimately looking at the forensic, you know, associated with bringing the systems back up online. You know, the enterprise customers that are using some of the well-known brands, the cyber insurance community ultimately brings those same capabilities and those same teams into the smaller space to better ultimately not pay and really make the right decisions with legal counsel's oversight, but also with the forensic capabilities that the insurance policies bring to the table. And again, I think it's something that the underwriting community, you know, as we look at ransomware, and again, it started, I'd say, from a frequency perspective in late 2017. You know, this is something that is not brand new, nor is it anything that we have yet to really encounter, you know, a good control mechanism for. But it is that difficulty of weighing the pros and cons associated with that important decision when faced with a ransomware encounter.
Okay, let's move on to the affirmative cyber insurance, and what is that in distinction to, right? There's a name for this. Why is it affirmative, and what are we trying to deal with by the creation of this affirmative approach to insuring these risks? Matt McCabe, you want to take that?
Yeah, I think it was Matt Prevost.
Oh, okay. I'm sorry.
Reference. I'd be happy to, but Matt, I'll give you the floor since you brought it up.
Yeah. So there's a recognition. I think we've heard it, you know, throughout the previous sessions. Is cyber risk is truly an enterprise risk. You know, it has impact. Can have physical. You know, cyber risk can have impact in the physical world, can have impact in the digital world, and obviously from an insurance context. The insurance policies that cater to specific events also have something that's referred to as silent cyber or non-affirmative cyber, or certain policies take an affirmative approach to cyber risk. And that can be either in the form of an exclusion, or it can be in the form of a trigger or an ultimate give on that coverage. And I like to kind of simplify this as, you know, cyber insurance underwriters underwrite the trigger of a cyber risk occurring, and that's what we do. Whereas other lines of business historically have really looked at what the result is. And as an example, and I like Randy, I like your reference to the fire insurance marketplace historically. You know, the first two questions on a fire insurance application that the underwriting community thought was predictive were, how many trees do you have in your front yard? And you know, obviously that line of business has evolved over the years. That's ultimately what a cyber underwriter is focused on, is how do I eliminate this trigger so that it doesn't have impact this organization. And you know, again, to go right to your question, that's a big topic in the insurance industry right now for recognition of where does cyber fit, right? So does cyber fit in a dedicated standalone product, or does cyber just present itself across all lines of business as a risk? And you know, between the policyholder, a broker, a risk bearer, whether or not that's a primary insurer, whether that's a reinsurer, whether that's the insurance-linked securities marketplace. That's the big question as it pertains to cyber risk in insurance right now.
Okay.
And actually, hey, Randy,
Yes,
Randy,
Jeff.
just one point on this, and I think this is not specific to just cyber, but the whole insurance industry is migrating from understand the risk and cover to predict and prevent. And I think part of this is sorting out the stealth or the silent cyber cover from the affirmative, figuring out the risk segmentation. That's in line with this view that we want to have a better understanding of really partnering with clients to understand how to better make them more resilient. And so, again, another reason why the analogy, the moral hazard question is not really applicable here.
Yeah, and we will get to the whole question of underwriting and the ability to predict and prevent. But let me go back to the question, the property and casualty question, or the silent insurance question, which had to do with whether you were affirmatively taking the cybersecurity risk or you found that a cybersecurity incident was potentially triggering coverage from some other policy. Is that a fair way of stating it? Does the fact that for most of those 20 years, or for some good portion of those 20 years, cyber was creeping up as a potential risk in a policy that wasn't dedicated to cyber, does that make the value, Matt McCabe, to your point, the value of the data that we have in the past more suspect, or can the companies extract the right answer from that? It seems to me that you can abstract some underwriting intelligence from it, but you can't abstract the loss intelligence from it, because quite understandably, many companies' positions was these cyber incidents aren't covered under these other policies, right? This risk was not designed for that. So how do you try to figure out I've read a number of academic papers that bemoaned over the period the number of insureds who were denied coverage under these other policies, but it seems to me that it doesn't give you the right set of data for loss understanding. Is that true, or am I missing something there?
Well, yeah, I think that's true to the extent for take a general liability policy when data claims started coming out, and the carrier said at no point had we intended to cover these losses, and they were quickly excluded. Now, I don't think that leads to years and years of data, because when they saw the first losses, they excluded the coverage, and lo and behold, that fed into cyber insurance coverage. For the 20 years of data that we're referring to that data in the cyber insurance industry, and I think it does prop up the underwriting for writing cyber policies now, but it's just a quick evolution. I would say the one thing that we have to be careful with on silent cyber moving forward, and I mean, the concern is if you take a property risk like electronic data and what we would call the bricking of components, does a carrier have language that it's covering it on its property policy and its cyber policy, and is it going to pay out twice on that incident, and is it aware of that double exposure? I think that's what it really wants to look to for the issue of affirmative cyber coverage. But the way that this issue is shaking out is that there are gaps being created on traditional lines of policy, because there's cyber language that says, look, we're not going to pay anything cyber related unless it has X and X trigger, and they're denying a conventional trigger. And I think what's really called upon by the markets is technology is in every aspect of our business, and you have to learn how it affects your coverage, and you should not be moving towards excluding it simply because you're nervous around it. There's underwriting to be had regarding technology on every line of insurance.
Yeah, and a lot of the larger markets who do have a cyber insurance practice are also educating, other lines of business across, various topics, anywhere from what is ransomware all the way to very sophisticated perspectives on, where is the Bohn and where is the exposure that you have to eliminate. That's also a benefit that significant cyber insurance investment has is really on the education front.
Well,
on underwriting.
So we'll get to underwriting. That's our next topic, underwriting. I want to just say one more question about this whole the notion of sort of the mixed risks that Matt McCabe just pointed out. If you brick someone's server, is that a property loss or is that a cyber loss? One of the most popular, I hate to say it, but one of the most significantly spiking types of criminal behavior that is lumped frequently as a cyber risk, although I would question that that premise is business email compromise attacks, right? The most recent FBI report from 2019 highlighted business email compromise as the most significant, one of the most significant increasing risks that folks face, small businesses and large. And for those who don't know, a business email compromise is one where a bad actor inserts him or herself into the stream of communications at a company and essentially figures out a way to direct the payment of funds inappropriately to an account where it doesn't belong. Some would say that is a sort of a classic case of a failure to have internal controls and not a cyber risk, but people have of late been able to manipulate Office 365 to direct emails in certain places, which comes a lot closer to a cyber type of intrusion. How do you deal with something like that? Is that part of what you're talking about as a gap, Matt Prevost? Would that fall in the middle, or is someone's going to need a special endorsement for BEC that does this, because otherwise they're not going to be covered? How are you handling the evolution of the threat in relation to what is essentially a lagging change in policy? I mean, Matt McCabe said, well, we saw the first data loss, we changed the policies, right? Okay, but the policies are prospective changes. They're not retrospective. Is it always going to be that the insured is one step behind because of the way of this sort of approach, or are they going to find coverage as the threat evolves?
No, I think a perfect example is BEC events, right? So crime marketplace, which is also really a burgeoning market that offers social engineering coverage. And also the cyber market or a business email compromise itself, you can have two policies responding to the same event, but there likely is different dollars. So just from the most simplistic way of thinking about business email compromise is the funds that are transferred ultimately falls into a crime bucket, but the forensics associated with the business email compromise typically would fall into the cyber insurance bucket. And a lot of policyholders think, okay, well, why don't you just combine the two and make it very simple and straightforward for us? Which, again, many carriers have done that, or many carriers have put it in, a cyber delivered product that offers crime coverage, or a crime product that offers some element of social engineering coverage. But again, the other aspect of this kind of evolving threat is really the control to mitigate, business email compromise. Multi-factor authentication. I think one of the previous speakers mentioned kind of when working from home, your personal life really brings things into the equation, and the simplicity of identity access and the simplicity of multi-factor. Really, I think, again, as the optimistic perspective, even just on the topic, is people will think more seriously about kind of the attack surface. But also, not many policyholders nor their employees are specifically thinking about which insurance responds at which given time. I think the unfortunate side of that is that, that is a responsive or almost an after the fact scenario. Whereas as kind of the predict and prevent approach, we're ultimately explaining and offer certain things at no cost that many policyholders aren't necessarily taking advantage of. Password managers, kind of the right training or employee training that, the products, the insurance products and the coverage, are offering, and irrespective of whether or not that's crime or cyber. And I think that's kind of where things are are going. I like Jeff's comment on the predict and prevent, because ultimately our goal is to eliminate kind of not just coverage uncertainty, but also just from a risk perspective, reducing that risk. And I think BEC is right in the bailiwick there.
And we have a question about whether cyber insurance plans also cover D&O, or is a D&O a separate? I mean, do the directors who unfortunately don't take the time to help their companies evaluate strategy and are subject to potentially some liability, are they going to look to the cyber policy or the D&O policy?
Typically, and I'm going to, Matt McCabe, I don't know if you want that one or.
Sure. I mean, give on to D&O. What is D&Os? I think in the last presentation, Melissa Hathaway said, look, you have an obligation to understand the financial threshold or the disruption of operations or the exposure of data that's going to create a material risk to your company. And if as an executive, you fail to address that responsibility, that's a typical D&O claim. And this is just another example of technology being interwoven into every aspect of business and also every aspect of your insurance program. So you should expect an allegation that a director or officer failed to fulfill their fiduciary duty because you didn't pursue a commercially reasonable cyber insurance protection and response program and didn't preserve adequate cyber resiliency. That's a D&O claim that you failed your duties overall, and it should stay under D&O. Cyber insurance is, I was financially impacted by your cyber lapse and here are my losses. But that's, not the share value or derivative claim.
Okay. So Jeff, you talked about predict and prevent. Let's go into the predict and prevent concept. How do you, from your standpoint in the reinsurance realm and otherwise, how do you gauge the maturity of the underwriting function? That is the ability to both accurately assess the risk and give the insured some information about how to reduce that risk, which benefits both the insurer and the insured. What's your view of the state of the effort?
Well, I think all the comments have supported this view that it's changing very quickly and it's still very new. Even this link back to D&O and the disentangling the silent cyber and being more explicit about that piece. These are all trends that have happened fairly recently. And we still view this as very much a development effort where we're working with technology partners and also going to the direct insurers to both exchange data and then provide our insight on areas that we think we can improve. If you look at the fact that there's still not a wide variation in pricing, that just suggests that I think that there's still a lot of work to be done, both on the data collection and then really understanding more from a technology perspective. I think that's the piece that's developed quite quickly and entered into our R&D agenda. We have some technology partners that have very interesting ways of looking at vulnerabilities, and I think that will progress very quickly. The short answer to your question, though, is we're still at the beginning of this kind of work. It's about shifting the mindset so that we can bring these new tools to bear on the process, and also give those tools to direct insurers. This is the perspective of reinsurer, but give those tools to direct insurers and then ultimately to the customers so that they can improve their resilience and eliminate those vulnerabilities.
Thank you. Matt, do you see a difference depending on what part of the market we're talking about as to the ability and of underwriting and the ability to provide lessons to the insured? I mean, is someone that gets sort of $100,000 of cyber insurance as part of their State Farm policy in the same position as someone who's going to a Marsh Mac insure, someone who representing or to Chubb for a large policy? How is that gradation across the market?
I'll take an initial spin at this, but of course we'll also give the threshold to, or give the platform to Matt Prevost. But the way I look at it, sure, if you are a large company, you are insisting and requiring a more manuscripted approach, and there is a high level of engagement, but you probably need less help from the carrier as well because you have a robust program. Although you're getting less of a touch point as a smaller organization, resources typically are being made available to that company that they might not otherwise have had. So at no point should we be dismissive of what cyber insurance does for those small and mid-sized enterprises, that they might be the ones that are benefiting the most because they just had that gap to fill.
Yeah, I would add, I mean, it's almost the underwriting process itself ranges, and as such, so does the kind of the interaction there. I mean, I've spent 3 days with a CISO, one company, consecutively underwriting an account, which that exchange and that back and forth and kind of the question and answer session, the underwriters are learning a lot, but also it's the chance for the CISO community to ask us questions, right? And just given the circumstances we're in, we also had a lot of customers ask us, what should we be doing as we transition to work from home, which I think is a good sign, right? And I think that varies. As Matt said, we offer a lot of services at no cost and have been doing so for about 4 or 5 years. A lot of, I think, the challenge is that the insurance side of the company, again, regardless of size, and the decision makers associated with the insurance purchase probably aren't, again, I think this isn't a controversial statement, as dialed in the CISO or the cybersecurity team, or if it's outsourced, really the capabilities that they have as they should be. So when we say that, we offer password managers for up to 500 employees, explaining that to a risk manager is pretty straightforward. They're an enterprise-based customer, but explaining that to a small business, a lot of them have yet to hear of what a password manager is, which is really the challenge we're faced with. So it does run the gamut. And really, I think, that's where a competitive advantage can be on a both a broker perspective as a risk bearer. And obviously, if risks are taking us up on those controls or just implementing things that are at no cost to them, we're starting to do the right thing as an insurance carrier component.
Jeff, do you see differences globally among this issue? I mean, are there places where some aspect of regulation or some aspect of culture has made the underwriting process more successful or less successful, or is it pretty much the same globally?
No, I think it differs. You have different regulations, say around things like data privacy in Europe relative to the U.S., relative to China. I think that there's a need more on the Western side, I think, to up the technological understanding beyond just the CISOs and the risk managers, as was explained before. In some of the other countries, I think that there's faster experimentation. This is predominantly in Asia, like in China and Singapore. So people are on different tracks, mostly as a function of the regulations and the culture. I think insurance in China, for a variety of reasons, is not. It moves a little quicker. People have a more positive attitude about it. You move to some of these other countries, there's a lot of skepticism and regulatory pushback that can affect the development of some of these new markets. I mean, you can even see it with some of the insurance discussions around the COVID pandemic, just what is covered and what's not covered. And I think we'll see more of those conversations, particularly in this broad cyberspace, because we're just going to see more activity that will have to be categorized, explained. And often the tools are out there, but people are just not understanding them, or they're not buying them, or they're not implementing them. So I think that's the challenge.
If you think about information flow, which is obviously the lifeblood of the ability to underwrite in some respects, do you see that there's a paucity of information? Either from it could be from the broker standpoint, or it could be from the insured standpoint. But generally, when I've met with insurers, they're upset that companies are loath to provide them with the detailed information of an actual breach that would help them underwrite. Is that still the case? And should there be affirmative changes to loosen up that information from your perspective?
Yeah, well,
Prevost,
go
you
ahead.
guys are not upset, are you?
Yeah, Randy, just as an example, again, Chubb, one of many markets, but we started to put our cyber claims information out to the public, right? So, and obviously a private and confidential way, but we developed really in the Veris framework, asset actor action, and for our policyholders, for our brokers to really look at historical claims by year, by industry, by size, and really what is driving at our actual claims, which I think is, that we put that out about 2 years ago. It's been well received by the cybersecurity community because it's in the spirit of information sharing, rather than an insurance company just simply asking for a lot of data from policyholders without actually, adding value, or really enabling them to understand why we're seeing events. And that's been successful. And I do think that's going to be an obvious trend across the cyber insurance marketplace, to share more data specific to claims, but also just to educate, right? Just the broad education around what is causing cyber claim. Again, most of us on this call, phishing and the basics are even the same exact scenarios that the nation state actors are focused on. Unfortunately, these are not, these aren't that complicated, right? So there's elements that I think, that kind of knowledge just has to transform from a cultural perspective.
Jeff, did you have something you want to add to that?
Well, no, I was just going to say that there's not enough data. I mean, I think it's getting better.
Never enough? Is there never enough data?
Never enough. I mean, I am ultimately a data scientist, but I think that this is a huge problem, and it's about getting data that's sufficiently homogeneous that you can actually run, meaning as you categorize it into pieces, depending on the segment, depending on the geography. And this is also where you see differences geographically. I think that there's probably more data in China, relatively speaking, than other countries in this context. And so I think that's a challenge, but it's also not necessarily transferable. So if I'm trying to do modeling in one country, I'm not sure that easily transfers to another country always. So these are the debates that we're currently having.
So let's move on to one of the topics here, which I know is important to folks, which is this notion of accumulated risk or aggregate risk here. The classic example is someone manages to take out a big cloud provider or big cloud instance, which will run across hundreds and hundreds of different insurance policies. And the other one, of course, is something like an active war scenario, or a near active war scenario, or a potential active war scenario. Maybe that's the way we should put it. An unclear active war, which takes out a large measure of the internet or something like that with horrible cyber events. How does the industry conceive of and deal with this notion of accumulated risk from a large event? Let's put the active war aside for a second, because I want to get to that when we get to some talk about regulation in the last few minutes. But how do we think about this accumulated risk problem? And Jeff, I'll start with you, and then we'll go to the mats. How's that? Yeah, no,
I think this is a critical issue for really scaling up this market. We've talked a lot about the size not being huge right now, but we think that it will grow. I think that one of the key components going forward will be, and I know this is a bit controversial, and I guess I should preface this by saying this is my opinion. I'm not representing my company, but we really should have backstops from governments to really provide a foundation to build this out, because there's still many issues. I mean, as we talk about the war question, even defining war is not straightforward in this context. And that's just one of many developing issues that create uncertainty around this accumulation risk issue.
Yeah, Randy, the investment in modeling tools and the significance that, cyber risk does present a top basis risk overall for insurers. That has to be understood and respected, right? So, I think we look at some past events, not petty as an example, and really the respect for the cyber triggered peril really occurred, right? So 2017, I think there was a newfound respect for the importance of understanding cyber, but also the importance for modeling, cyber events. I think there was commentary on, not just pre-mortem thinking, but really be paranoid, right? And that's how the cyber insurance, I think the underwriters that really respect the cyber risk that presents itself have to think about this. And just the investment from the insurance the risk bearer side, also from a reinsurance perspective, that is a key investment to ensure that this is, a sustainable, long-term, profitable, with full recognition of the cat exposure type risk. And that's, again, there's been evolution over the last few years on the not just data availability, but just from a some of the different systemic tools and the different modeling companies, they're investing as well, which I think is a good sign, right? We are looking at this on a pre-mortem basis, looking ahead as to what could happen, what likely will happen, and ensuring that, from a cat preparedness perspective, that also is something that presents itself, right? The question of, are there enough kind of forensic experts to really immerse themselves in a cat event? Is that something that we as an industry are thinking about? And that's something that we have to respect and recognize.
Well, to go with Jeff's point though, is the absence of some sort of government backstop, and Jeff, I'll let you, if you would, elaborate on that, but I assume it's something like TRIO or something like an insurer of last resort in the face of a huge catastrophe. Is that going to restrain the size of the insurance market if there isn't one? In other words, is everyone going to be at a single digit % of their risk because they can't deal with the aggregate risk any other way in the absence of some sort of government backstop?
Well, I think it's hard to predict whether, where that goes without it. But I think if you look at the development of other types of perils or risks where there's uncertainty and immaturity in market development, and the concern about accumulation risk really does constrain the willingness of, call it the collective capital provision community, starting with reinsurers, that creates a constraint, I think, on how the market grows. So, I would say that will constrain it. Whether that just means it takes longer to develop, I mean, that's the debate that I think we would have to have.
Matt McCabe, do you have something you want to add to this aspect?
I mean, for the aggregation issue overall, I think that, and this kind of links back to our last conversation about data collection. The best renewals that go forward is when there's a really earnest discussion between the insured and the insurer, and there's a very frank exchange of what their cybersecurity protections and procedures are, right? And the carrier gets the opportunity to collect all that data on how cybersecurity is being performed. I think claims data is tricky, but there should, as far as, there's often very many reasons to keep that confidential, but the data collection side gives the carrier an opportunity to look at aggregation. But the carrier also works against aggregation by its contractual terms, by excluding losses resulting from outages of financial markets or power utilities or internet service providers. So the unfortunate part is that potentially those are gaps in the policy because, I'm just kind of sticking up for the market here, but they see those large positions of aggregation, and there is some effort to address it now. Now, as far as the national scope problem, the backstop concept can be very helpful, but part and parcel of our difficulty right now is defining terms around this. So in 2017, the NotPetya attack came, and everybody threw around, I mean, from a sensationalist standpoint, in my perspective, the term warfare, where even if you read the recounts of it, understood that it was attributed to a nation state, but if it was an outage of retail systems and healthcare checking in, but had no military purpose behind it, I don't understand how so many pundits leap to the term of warfare. And I've been a hawk for a while that I really don't think you can consider that an act of war. So what are we going to consider these nation state attacks that fall short of the severity of warfare, but might have large impacts? And if we can get around the conversation of what we're going to describe that, maybe we can get into the conversation of how we're going to treat that and whether it comes down to being a federally backstop program or not. You know, I would say in 2016, the Department of Treasury considered or codified cyber insurance as one of the covered lines of insurance underneath TRIA. Now, who says, you know, how far that can be expanded to? It all relies on the trigger of a certified act of terrorism declared by the Secretary of Treasury with Justice and Homeland Security advising. But if you're looking at an aggregated impact of these losses, and that overall impact is significant enough to trigger TRIA and say that's going to meet an act of terror, the definition of an act of terrorism under the statute, maybe TRIA becomes a much more helpful device for addressing these kinds of risks.
Yeah, I would just add, just in the spirit of the Solarium Commission report and kind of engaging, there's a clear recognition, not just specific to TRIA, but also just in general towards the future of really engagement between the insurance community, but also obviously, you know, DHS, Treasury, DOJ, a variety of different kind of, and this is all US-based commentary despite these forums being global in nature. There's definitely a level of engagement that I think needs to continue to increase, right? So, but I also think there's actually pretty good evolution on the topic overall, specific to cyber insurance, just from an understanding and awareness standpoint. But again, we're focused, and again, I'm referencing the cyber insurance market overall. We're focused on what, you know, reports like the Solarium Commission report put out, not just in the United States, but more broadly, right? So some significantly varying views on this doesn't make this obviously an easy conversation, but it also is really a challenge that we think it's got to be a combination of you know, forces, you know, to group together on a global basis, which is difficult, but you know, I do think it's important.
Yeah, I think it's, you know, for those who don't know, the Solarium Commission report on that was recently released advocated for cyber defense and affirmative cyber defense, if you will, offensive cyber operations that fall short of war, occupying the opponent's networks to the extent possible to prevent attacks and the like. So it really does raise, as Matt said, the whole question of what do you do with something that's on purpose not supposed to be an act of war, but nevertheless could result in some sort of disruption, particularly since, at least in the United States, and I think is true to a very significant degree around the world, you know, most of the internet and infrastructure data, et cetera, is all privately held. So if there's going to be retribution, it's a doubt it might well fall on a private actor as a result of this position. So I think I just wanted to explain why Matt Prevost, the Solarium Commission report, his mention of the Solarium report was so significant in this area. Well, we are at 12:59. We are just about to, no, we're at 1. I want to very much thank Jeff, Matt, and Matt for being with us. And I hope that this, at the very least, whetted the audience's appetite on cyber insurance issues, the questions of risk spreading, the questions of underwriting to reduce risk, to predict and reduce risk, as Jeff Bohn said. So Thank you all very much. Thank you to my panelists. And Dick Berner, I think I'm turning it back to you.